Hey, everybody. Good afternoon. This is Doc Severson and Dave Lukas with 12-Minute Trading. Today is Monday, the 28th of November. We're back from the Thanksgiving holiday, and we have all kinds of volatility happening in the market. Dave, how's it going today?
Hey, it's going good. It's great to be back with everybody too. Glad to have a little time for the holiday, get back to the carnage, right? So we are going into some seriously volatile weeks over the next few weeks. We're seeing the start of that today. Today we've got China in disarray overnight and over the weekend. So that's causing some things. The second largest economy in the world, maybe shutting down again, and then they got a lot of protesting and stuff going on. Maybe their Tiananmen moment in the modern age, if you will, is potentially happening. So you got that. You've got Fed speakers all over the place saying things all over the place themselves, right? So you've got William saying one thing, you got Bullard hawkish one second, more dovish the next. It's been a pretty wild day if you're reading the tape on these guys, but it's what you'd expect. Markets are a little bit manic when these guys are out there, and you've got Powell speaking on Wednesday still. You got PCE coming out on Thursday, which is the preferred gauge of inflation from the Fed. And then you got the jobs report on Friday. So this week is going to be a roller coaster ride. And then next week we get a little bit of a reprieve because you get a blackout period with the Fed speakers, and there isn't much in the data way of things. And then the following week, it really hits home with CPI and the Fed decision Tuesday, Wednesday, back to back. So that's welcome to December, and that's where we're at.
Have you ever seen a bigger U-turn in terms of the approach of the Fed? I mean, through the past 15 years we've had the Fed. I mean, everybody jokes about, the Powell GIF that's out there where, he's like firing out dollar bills and stuff like that. But it's like they've done a total 180 now, and they are the market's biggest enemy at this point. And it's just amazing to watch.
Yeah, they are until they're not, right? So that's the whole thing. So last week, low volume week, right? So these low volume weeks, we got the holiday in the middle of the week. You got a shortened trading week, basically 3 days or so of trading, and everybody's gone. All the traders are gone. It's the algos just trading off of news bites, which you're seeing today. Every little thing that Bullard says or Williams says or any of those guys is, spiking the markets one way or another. Those algos are trading those. So last week we got, some decent upside and mainly going into the Fed minutes, which the Fed minutes did show that they are willing to slow down, right? And that's what the market wants. The market, there's two things it cares about, two things the Fed cares about. The Fed wants to slow down the jobs market, and it wants inflation to slow down, right? So if they are signaling that they see some of that happening and that they can slow down their, raising of rates, it's positive for the markets. Now, if you had told somebody that at the beginning of the year, or even let's go back a couple of years. 2 years ago, if I had told you that you're going to have 7.7% inflation and Fed rates over 4%, approaching 5%, what would you have said about what was going to happen to the markets then?
Oh, I had expected to be on the floor.
Yeah. So it's funny that we're celebrating the level of inflation that we were in February. Like that's a great thing. We are at the same level of inflation that we were in February. So it's amazing how people's mindset shifts after being in a certain type of zone for a long enough, right? It's people and the markets have gotten used to inflation being here now, right? So now you've got a market that's just like, well, if inflation subsides a little bit and the Fed slows down, even though they're going to raise 50 basis points or 25 or whatever it is into the next year, it's not 75. That's a good thing, right? Where just a couple of years ago, that would have been Armageddon. You know what I mean? It's just amazing how the sentiment shifts.
It's funny because we see some of the same concepts of technical analysis in everyday life. Like one of them is former resistance becomes new support. So we see, the price banging against a certain level, then it pops above it, and then it tends to come down and find that as support. So we've always used the analogy of like jumping against the ceiling until you finally break through. And then you pop out into the next floor. Like when gas was high $2 a gallon, like it got up to 3 and you're like, oh man, this is terrible. And then it got up to 350 and then it goes down under to 3 again. You're like, oh, party time. This is awesome. Right? Let's fill up.
And it's kind of like the frog in the pot. You've heard the old adage of you throw the frog in the pot and you're boiling and the frog slowly boils. They don't even notice. They don't even jump out of the pot. Right. And it's kind of the same thing with, these markets and that sort of thing. And I'm not using it in the analogy like the market's going to crash, although that's a possibility in the coming months. But you're in something long enough, you get used to it. It becomes kind of a bias like, any little, like this is the status quo. So any change that seems favorable to the status quo all of a sudden is like, oh, this is so good. Where if you just zoomed out and compared it to something just a little bit further back, it's like totally would have been unheard of, right? Would have been the craziest thing in the world. And so that's where we are, right? And so we're getting some pullback to start this week. We're giving up the gains from last week, right? That we got in the holiday shortened week, the low vol week. But kind of what you just said, right? We're coming back down to that last level of resistance, which is now support. So that's going to be the key thing, is to watch and see this kind of 3,900 to 3,950 level on the S&P is kind of that same level. Can we hold that, right? If we can and really find support there, that gives us a good chance to get and run higher, especially. Now, remember, guys, anything right now news-wise, the market is very jittery, right? And so if you get a positive jobs number, like, for example, job surprise to the upside, market's going to take that and really sell off. If the jobs number comes in light, maybe even just kind of in line, right? Then markets may like that. You got Powell speaking. If Powell says one thing to hint that, we're going to slow down and we can start to slow down a little bit, markets skyrocket, right? So you're in this kind of world where you're going to have these maybe one day up big, down the next. You won't really go anywhere, but it's really, really volatile. Get through all that mid-month and then maybe get your Santa Claus rally. And that's where we see ourselves kind of run up from this level here. So,
well, funny you mentioned that. Let's take a look at the charts here. And so one of the things that I'm always looking at is the average swing length. Average swing length, if we go back to March, April, 496 points. So let's just say 500 points. Okay, what did we get from July into mid-August? We had about 600 points. What would be right smack dab in the middle of that? 550 points, which is about where we tagged into the last couple of weeks. That is it. So we're right at the average swing length for 2022. And so what's going to happen here? Now, what I want you guys to watch out for is really what has been the bane of the existence of this market, which is the evil lower high. So all of these happened off of pullbacks, just like what we're going through right now. And then we rallied off the pullback. And then all of a sudden the market got surprised by some data each time and created a lower high each time here. So the market rallied into something and then it didn't happen. And in fact, the opposite happened. And it's usually was driven by the Fed. In some cases, we did have a bad CPI number, or we just had Jerome Powell being obstinate back here in late August, which drove that first lower high. And this is where you're going to get really, really quick moves. So looking at today's move here, we're pulling back down to the expected move for the day, which is that blue line. We have some support down here at about 3,900. We have, just above 3,900 or so. We have that trend line. That is probably not going to get through that on the first try down. So what you got to watch out for is any bounce from there, which fails at 4,000. That could be our lower high. So right now, as long as the market's heading down, which it has been all year, you have to assume that we're going to get more downside, that surprises are going to still come to the downside. The market will let us know when this is all over. The market will let us know when the bear is done, because we'll start to blow through trend lines. We'll start to blow through the 200-day moving average, although the Dow's already done that. So we have kind of this bifurcated 2000 to 2003 type of market right now. where we had the Dow was very, very strong back then and the NASDAQ was extraordinarily weak. We have almost the same thing going on this year.
And Doc, to add to that, actually, if you don't mind, pull that back up real quick. If you don't mind, show that chart again real quick. I want to cover a few things. I want to zoom out and talk a little bit of macro and talk about going into next year, right? So go ahead and pull that up again and we'll talk a little bit about that.
Yeah, got it.
Great. So the thing that I want to mention here, and you can see it on this chart, he talked about, you see that last move, 604, then the pullback, 549, obviously where we're at now. Now that 604, do you remember what that was? That was right before Jackson Hole. And that's when Powell came out and basically said, we're going to bring the pain. I feel like Mr. T, right? What's your prescription or what's your call for the fight? We're going to bring pain, right? So that's where we are again, right? Powell speaks on Wednesday. So is he going to come out and basically say, it's going to be painful, or is he going to say we're reaching the end of the rate tightening cycle? Now, there's a couple things with this. First and foremost, I think that he could actually say that because that would coincide with the Fed minutes, because the Fed minutes basically said that they can slow down the not so much the pace, but the level, right? Go from 75 to 50 to maybe 25, right? So I think he could definitely echo that with their minutes. It would make sense. He's the guy that signs off on the minutes and all that stuff. Now, here's what we could see, right? We could see that spur a rally, and we could get our Santa Claus rally into the end of the year. Now, if you have watched markets and have been a student of the markets for a long time, one of the things that you'll notice is that typically you get that Santa Claus rally in the back half of December, and you get into January and then things fall apart. Typically each year, January is, especially after a good Santa Claus rally, tends to be pretty volatile and tends to have some negativity in the markets. That also will probably be about the time that the Fed rate hikes that they've been doing actually start to really hit the economy. So remember, you've got a lag in all this stuff. And so a lot of what the Fed has done so far hasn't really hit the economy yet. And that's why watching the jobs number, if you start to see jobs go lower, you start to see a negative print on jobs, that's starting to tell you that these things are taking hold, but it's only the beginning, right? And so the Fed is always notoriously late to act, and they always go too far when they do act.
Well, guess what?
So you need to be prepared.
Watch what's happening in the bond market right now. The bond market has been, since the latter part of October, about a month now, the bond market has actually been in a downtrend. And so this is 6 to 9 months from now. This is the bond market saying the Fed's way too late. The Fed is going to keep on going in this direction, and it's going to be, it's almost like the difference between a map and compass versus a GPS.
And the bond market is typically smarter than the Fed. And so
not
what
typically,
you need to be prepared.
Always.
I was trying to be nice. But what you need to prepare for as a trader is you're gonna probably get one last good run higher, and then you're gonna get your next really big swing down, unless it really gets torpedoed with the data over the next couple of weeks, because there are some landmines in there. But I think Powell's going to give that type of language the market wants to hear, or the market will at least pick something out of that it likes, because I think this market wants to run higher into the end of the year, but then all bets are off. So use the swing that we're going to get, out of this to clear the downsides and get ready. And it's a great time to sell into the top side. So it'll be a great time to sell up the call spread side if we go parabolic from here, which is possible, right? If we really see kind of almost a top blow off, great time to sell those call spreads into that and then let it fade off into the beginning of the year. And then by springtime, we'll kind of be back to normal. Probably, usually with a bear market like this, you'll have kind of found your bottom about that time. That's about the length of time a bear market typically goes, and where you start to see your bottom and everything come in, right? So the Dow's already ahead of the game, right? But we'll see if if it can hold it. That's kind of the big thing right now. So that's kind of where we're at. But yeah, be prepared just for the beginning of the year carnage. You saw it last year or the beginning of this year, which led into the bear. And if you look historically, a lot of times that January, that first month of the year, typically is pretty nasty after a good Santa Claus rally.
Yeah, and don't forget that tops are a process,
Yeah,
and bottoms are an event. So it will not just typically drop from the top of the swing. It will set the hook by pulling back and then rising into a lower high. And that has been the recipe for disastrous downside throughout this year, is setting the hook through a lower high. Because what it does is it gets all retail, especially all retail, leaning long, and then all of a sudden they yank the carpet out from underneath them, and retail's got nowhere to go.
The market will bring the most amount of pain to the most amount of traders that it can. So you got to ask yourself, where's the pain right now, right? Everybody thinks that everybody sees what we just showed you on the charts. Everybody said, okay, this swing, we're about to the end of it. Let's get ourselves, and there's been a lot of put buying and everything else. Let's get set for this drop down. So that's the time where you see this thing rally in disbelief, and get everybody to follow it, right? And that's what causes it to go parabolic. Everybody jumps on board because it's FOMO. They don't want to miss out, and they run it up, and then that's when the rug pull happens. The obvious is not usually what happens. It's the opposite of that. And so that's the big thing to watch now, and we'll know over the next couple of weeks. It'll absolutely reveal itself. If we're going to do that, great. If we're going to really fall off the cliff, then that's potential too. It's going to be based on the data and the way the Fed acts. So those are the big things. So just make sure that you have your defensive solid and you're shored up and ready, but also be ready for that kind of just crazy run up. We saw that last year too. We saw that last year at the end of the bull, where everybody thought, oh, this is done, it's over. And then literally in a week span between Christmas into New Year's, it ran up like crazy, and then the first couple of days in January, and then crashed, so same type of thing.
Right, absolutely. So yeah, after a while, you start to see the same patterns occur again and again and again. And it always follows what you talked about, where what does the market have to do to create the greatest amount of pain? That's what will happen 9 times out of 10. So
it's very good at it too.
Yeah. All right. Well, thanks everybody for attending today. So whether or not you came in live and joined us live here, or whether you're going to watch us on a replay later on, welcome aboard. Thank you very much for coming in. And that means that you subscribe too. So if you're not subscribed, please do that, because you'll be notified next time we go live, which should be next Monday, right? You're going to be around Monday?
It will be. Yeah.
Okay.
Monday.
All right. The Monday it is. So thanks everybody. And, join us, subscribe, and join
Hit the like button. Tell more people about it.
Yeah.
Beat the algorithm. Share this out there.
Beat the algorithm. All right, guys. Thanks very much. We'll see you soon. Be good.
Bye.
All right. Another good one.